Good morning, everyone. This is Ben Ryan to welcome you to another edition of RTA Live here from Hedgeye headquarters in Stamford, Connecticut. Keith's been on the road for a few weeks, but he's back in the saddle this morning. He's going to run through some levels, and then we'll just go straight to the queue. If you do have questions, you can type them in the dialogue box, so we'll do our best to answer them. Fire away, Keith.
Thanks, Ben. And for those of you that are new on RTA Live, just a quick apology. I'm generally not on the road for 2 weeks in a row, away from my family and my firm, which is the same thing. That is what it is, but I think that what I do when I go on these travels is get a little bit smarter as opposed to a little bit dumber, which is easy to do if I just sit at my desk. So again, that's where I was, but we were still working, obviously. You will see me get more active now that I am not on airplanes, trains, and automobiles, just FYI. What I would say first is that we've effectively run out of the catalysts that I was mapping for pretty much the last couple of months. You know, I've been kind of going back and forth on this, which is I wanted to see us get through the Federal Reserve's reaction to the GDP report, the slowing economic data, the jobs report, which is of course a lagging economic indicator, which is the last one that's supposed to be good and it's about to go bad, and then finally the Federal Reserve's decision, which was obviously this week, and I think it brought us right back to at least where the research process had led us. Now, whether or not the research process had led us to, I don't even know how I would have signaled it other than what I did in things like EDV. I think that we appropriately risk managed that from a signaling perspective, getting out of it on the bounces. But you know, there really was no research call to make until we saw that Federal Reserve react to the data. This made it very difficult for the last 6 weeks. I would say that if you survived it, congratulations. It certainly was not easy, but it is good to say, at least today, that we stuck with the process and did not capitulate. I think a lot of people were chasing charts, looking at bond yield, quote unquote, breakouts, and now they're looking at them breaking down. So again, we're not traditional technicians, and we're not going to apologize for that. Both the quantitative risk management process with the fundamental research overlay is the best part of what we have, and we're going to stick with that until, I guess, well, forever, I guess it would be a good spot to reference as the timing on that. Just to give you some big macro levels before I get into some what we have now, I guess we have 9 live ticking positions in real-time alerts. First, just give you a level on the 10-year bond yield. Bond yield's lows on the day here, so they tried to bounce it again up to 231, then back down to 228, now 227. Again, friendly reminder, there's no support to 215, and if they break that, there's no support to 198. Immediate-term trade resistance is 238. The trend line for our intermediate-term trend level, rather, for the 10-year bond yield is 2.40%. So we're finally comfortably. It was a very uncomfortable rip above that. But again, it didn't confirm itself, so just keep your eyes on your fries there in terms of those levels. The S&P 500, stick with what I had this morning in both the early look and our daily trading range product. That's what, 2104 to 2126. Just looking at it now, I think the only thing that would change that range, and by the way, my ranges change dynamically, so in other words, if I get a different volatility signal, in other words, if volatility, specifically I'm looking at 1303 right here, if the VIX can hold 1303, then I'm most likely going to give you another lower high of resistance for the S&P. If it breaks down below 1303 on the VIX, you're most likely going to get a higher high of resistance for the S&P. So again, that's how my model works. Price, volume, volatility. As volatility basically leads me to narrow or widen the risk range. And that's how I generate my decision-making process. That is very consistent, and by the way, it works. And what you have to do is basically sit there and wait and watch. So when you have something like the VIX right now, I'm basically waiting for Waldo here because you have the Greeks are the next catalyst, I guess. I mean, I've spent 2 weeks on the road with very sophisticated institutional managers, and not one of them was talking about Greece, really determining their decision-making process. That doesn't mean that into today, into the weekend and coming into Monday, they're obviously going to move the European market. So I'm happy to wait and watch and take down exposure. You saw me do that this morning. They were all eliminations of positions as opposed to adding positions, other than adding the transports back to the short side. Again, the research view has not changed on the transportation stocks, the industrial stocks, or the financial stocks. The only thing that's changed is time and space. So let's just get into it. DXJ first, that's the long side. That's probably my best idea right here from this price in macro, just because it had its proper correction, and again, proper being correlated to the US dollar. So again, now that the dollar has signaled oversold, you get yen overbought and Nikkei oversold. So again, these are highly correlated setups. And if you look at the DXJ, immediate term trade oversold down at 57.5, and immediate term trade upside to 58.62. So I like that one, or it wouldn't be on the list. OC, actually the other thing I took off was emerging markets. Don't forget that if I think that the dollar's going up for a bounce, I would be less interested in staying with that trading position we signaled earlier in the week in emerging markets. So that's gone. That had been my least favorite, as you know, long position. And it's okay to say that. I mean, if you've ever ran real money, I'd be polite in saying that I have positions in my book that are not favorites. Everyone who runs real money that has more than 5 positions understands that you will have dogs in your portfolio, and if you don't have dogs in your portfolio, your name is Bernie Madoff. So the reality is that I did not like emerging markets and how it was acting. That said, I didn't give up on it on the lows. We traded the lows appropriately, then I got out. That's typically kind of how I get myself out of trouble, is basically trading around it. And it's okay to do that. It really is. I mean, look at what happened to a lot of these positions. They had nice bounces, and we could have easily capitulated and sold utilities at the lows, emerging markets at the lows, gold at the lows, and we did not. And that is what it is. OC, right in the middle of its risk range right now, OC being Owens Corning. Immediate term trade support is 39.27. No resistance to 40.98. XLU, which I just alluded to, which is utilities, it's up on a rope here, okay? So it's immediate term trade overbought. Again, thankfully, the signal told us to stay with it. Again, the trend is still your friend in utilities, albeit it's been a long-term one. If you go back to 2011, and I wrote about this in the early look note this morning, in 2011 was a great time to be long utilities. And if you pull up a 5-year chart of utilities, you'll remind yourself what the efficacy of being long utilities looks like in a down interest rate environment. So obviously that was a great place to be this week, and if you stayed with it, I salute you. Immediate term trade support now a higher low for that at 42.58. Resistance, there's immediate term resistance right here at 43, just inside of 43.5, so I wouldn't be buying it here. I'd wait for the next pullback and then look for a push back towards 44. GLD looks almost identical to utilities, by the way. A little bit better. If I had to pick between one or the other, and I had to pick one that I'd want to keep in the portfolio over the other, I'm going to keep both because I think both work here. But I'd keep gold over utilities if you care. Immediate term trade support now for gold is just north of 114. It's overbought here in the 115, 116 range. If we can get through that, it's going to be 118. You know, that's kind of the bull case for gold is the bear case for bond yields. So again, that hasn't changed for a very long period of time. Dollar down, rates down is indeed what gold wants. And since the dollar's bottom, that's another good reason, at least for now, it's a good reason to kind of trim some of those gains in gold. Again, if I had a full position in gold and if I was staying with it into the catalyst, that's what we were doing, into the Fed event, you got to book some. Look, I don't get to average into everything the whole way down. I mean, if I was running my old fund, I'd average down into things 12 to 15 times. I mean, there's a lot of risk management that you need to take ownership in yourself when you're averaging into positions with catalysts. I'm just the poor bastard who has to sit here with a cost basis on a timestamp. I'm doing that because I fundamentally believe in being accountable that way, and I know it's harder, and I don't care. You know, life's hard. But the reality is that what I want to do is have you getting used to empowering yourself, averaging into things, averaging out of things. That's how real guys trade real books. So again, I can't do that in real-time alerts. I can help you in RTA Live, and hopefully I am now. Maybe I'm your coach. Maybe I'm not. Maybe I'm just a guy talking, which indeed I am right now. I can keep talking. TLT, immediate term trade support, is at a long-term higher low, just north of 116. No resistance really to 122, but the first line of immediate term trade resistance is at 119 and 119.63. So that is what it is. I don't know what else to tell you other than risk manage the range. Had a lot of feedback on like why would you stay with TLT the whole time? Well, we've been bullish on TLT since the beginning of last year. Nothing's changed since the beginning of last year. I just kept it there like I have Starbucks because I'm I'd say I have the most conviction of anything I have that global growth is going to slow for a longer period of time. Why would I take it off? I mean, I traded EDV, which is the long-term strips instead. You know, hopefully I'm showing you both, my long-term view and my trading view. And if I'm not perfect, guess what? I'm not. I mean, that's too bad if people want me to be. Starbucks, looking at that immediate term trade overbought. Again, I kept this one on for a long period of time. There's a lot of lot of times I could have given up on it, but I didn't. This is where we're at. So again, from 14 or whatever, $11 and whatever cents, we're still in it. That's fun, but I wouldn't buy it here. I'm not that dumb. Where are we at? 50. We bought it at 5.76 split adjusted. Actually, it's at 54.26. Looking at that thing now, it's immediate term trade up about like right here. I would sell some right here. In other words, if you're in a full position or anything like that in Starbucks. Short side, let's just do that. Let me get my screens up. I just lost it. Lost the screen being. IYT, I already gave you the signal. That's fresh. The two stocks I stayed with on the short side were one of our best healthcare shorts and one of our best retail shorts. So Brian McGough and Tom Tobin. Obviously, shorts tend to not work when the market goes straight up. I hope you're aware of that. This is right where you probably short more Mednax, which is MD. It's got no support, like literally to 70 and change. So significant downside in that. And then HIBB, which is Hibbett, had its bounce too, albeit on decelerating volume. So again, if you look at the process and you're trying to build your own process, please have volume as part of the picture that you're looking at. Again, if you're not looking at volume and having someone like me build you a volatility signal, I think that's a problem. I mean, a lot of people do pretty well fishing without a boat. That's fine. I'd just as soon as have a boat, a lot of beer, and some rigs and everything else, life's jackets too. Get as much as what you can that actually you could use. And volume and volatility are very important things. So if you look at Hibbett had decelerating volume on the bounce to lower highs. That's a clean cut, I don't care signal. So that means I'd short more. If the volume was accelerating on the bounce, I would be much more concerned about potential rocks under the water that I can't see, which of course would be using the fishing metaphor, which of course wouldn't be useful if you don't fish. So let's go with the levels on that and then take some questions. Let's say 48.26 is resistance for Hibbett, so a little higher than here with immediate term downside to 46.40.
All right. Thanks, Keith. Maybe before we get going on the queue, can you run over, just run through what it means to average in and then average up and average down, and how we try to express that in real-time alerts? Because if you were running a book and you had a stock that was 8% of your portfolio and it was overbought, I mean, you're going to average down, right?
Well, you're going to sell some so that you take down your gross exposure to the position.
Right.
Now, some people would say, well, I don't do it that way, and that's okay. I mean, everyone does it a different way. But what I do, and if it's of value to you, and I've done a lot of kind of coaching in as much as it's just called advisory work with portfolio managers, particularly younger ones that are just trying to build their own process. What I do is I have three. I like to work in threes. I think most people know that. But I have three different kind of threshold levels at both the long and the short side. So I'd have a 2% position, a 4, and a 6 on the long side, and then my shorts would be smaller than my long. So I'd have 1, 2, 3. It's like a basic setup that I use with people, which is, again, max long positions 6%, medium is 4%, and a new position I'm trying to work up to 2%. And within all those workups, I'm working the position. So again, if I buy it like real-time alerts, I got to be perfect. First shot, American Sniper, bang, every time. And that's not easy to do, obviously. Sometimes I have to come in with the second signal saying, look, I missed the guy, I got to hit it, shoot again. You can do this 12 to 15 times. You can do it 30 times. So what you'd want to do is define your position in terms of your conviction level. Super high conviction, and it's corrected, so you have the ability to buy and make it a full position, 6%. New position, not that much conviction, you're trying to get used to it, buy 50 beeps at a time, 4 times, okay? Then you're at 2%. That's how I do it, okay? Hopefully that makes sense. So up and down, and then if you're right on a big position and you did it right, like gold, let's say you like gold. You're scaling into it, GLD. Let's do this. You're scaling into it from May. Well, actually, let's say that you didn't do, let's say you totally screwed it up and didn't do what I did. Let's say that you started buying it because you thought the chart was breaking out at 117, which was in the May 12th or 13th period. Okay, now you're in trouble because you're getting bigger into the collapse down to 112. Okay, so that's what I don't want you to do. That's why I don't like it when people chase charts, because you get bigger into something that mean reverts and then you get smoked. Don't do that, okay? If you missed it, you missed it. Don't chase the charts. Again, if you're long it at 117 and you're long, let's say you're long 2%, Then on the way down to 112, you go take it to 3%, 4%, 5%, 6%. This is pretty easy to do. You had 5 other opportunities. You could have bought it at every dollar level the whole way down. Then it's at 112. It has a big move. You sell some. Take it from 6 to 5 to 4. Great.
Fade the range.
Fade the range. That's how you do it. I don't know if this is super simple, but in my head it is, which can be a problem because my head is a little too.
Well, the point I was getting at is that in RTA Live, you just have it's just a buy or sell, right? And it's not necessarily that. If it was actually your position, that's not necessarily what it would be. You'd be booking some gains, but not on an overbought signal, but not completely out of the position.
This is why over the years I've been trying to make real-time alerts a more practical product, and I add a lot more of my thoughts because my thoughts, you'll see a real-time alert, they have thoughts in one alert that has a lot to do with the other positions, or this is the best I can do. I mean, I can't be everywhere at once
it's gotten more
and hold
clear
everyone's
and more clear.
hand every single time, but I'm trying to use more words, and hopefully I'm telling you the process works. You can see it. I mean, the reality is that a lot of very successful people use a similar process. It's called scaling into positions. Very few people just put an order on the desk and say, boom, that's my full position. Own it there and don't touch it. I mean, if you do that, I'm probably not your cup of tea.
All right. Let's jump to the queue here. Levels on CGW.
CGW.
Yeah.
I thought somebody was going to start with Zoe's or
It's coming.
Kate.
It's coming.
Okay. The Guggenheim S&P Global Water Index?
Yeah.
Seriously?
Well, it's the ETF that tracks the S&P Global Water Index.
Of course, because we've been talking about water so much. You wanted to get that one out of the way. They have an ETF for everything. Guggenheim. Gotta love Guggenheim. I got some good buddies at Guggenheim. Hi, guys. 28, this thing's bearish trend, by the way. Intermediate term trend line of resistance for the Guggenheim S&P Global Water Index is 29.25. So it's bearish trend with immediate term downside support to 28.08.
Okay, has the research perspective changed on RCL? Can you give levels?
Research hasn't changed. It's actually looks like a spot where I should actually short some. Fortuitously, we covered that signal on the pullback. And this is a good example of one where I had no fundamental reason to cover it other than the signal was saying get out of the way. So thankfully I did. This is where, again, I'm going to have to, now that I just see the level, it's signaling overbought. The research call is still bearish. So after this, I'll go talk to Todd Jordan and Felix Wang and their new associate, the 3-person team. So that'll be 4 of us debating the question, and we'll make a decision. That's a good spot. If you're interested in shorting RCL, this would be the spot.
Okay.
I need to ask my guys if it's still if we have a catalyst.
All right. This maybe this isn't an RTA question, but we'll ask it. JP Morgan's Feroli says he sees Fed funds at 175 to 2 by the end of 2016. If so, what would the value of TLT be at that time?
Feroli and I don't have the same process. I can tell you that. I can't really entertain Feroli. I don't. If you're using Feroli, I apologize for your. That's mean. It really is. But it is. Don't use the sell side linear economists. And again, not to be mean, but please go back and audit Feroli's forecasting ability. Nice guy, yeah, but that is I think that's that's just a terrible call. I don't know the answer to these things. I don't spend my time trying to calculate that.
Yeah.
Some people do. They live in complete insecurity of their own lives. I mean, they're like, oh my God, I'm going to be wrong on bond yield. So what does Feroli think? Feroli's just a guy at a bank who came up with like a little equation that got you nervous. I can tell you, Keith McCullough says that the 10-year bond yield could go back to the all-time lows. Tell Feroli that and ask him what he thinks.
What is the forward PE of IWN, and do you think it is a good short here?
IWM?
Yeah.
What is the forward? I don't know.
Yeah.
I'm not a.
I want to say it's 20.
Yeah, punch it into
23.
Yahoo Finance. IWM is it. Look, the Russell 2000. I mean, one of the best ways to express buying everything, which I think I wrote multiple times to you. If the Fed did indeed do what I thought they would do, I mean, one way to do it is to buy the indexes. And if you look at the healthcare index, the Russell 2000, the S&P 500, they all moved straight up on the Fed. I mean, now they're all overbought. So whatever the PE is doesn't matter. I mean, I don't buy things on PEs. On macro, please. Let me tell you on macro. In macro, expensive gets more expensive, cheap gets cheap.
White wave levels.
Well, that's a good stock. We just did a conference call on that while I was away this week, and unfortunately I was in meetings all day, so I wasn't like signaling buy while Howard Penny gave a great presentation on why white wave should be more expensive. Immediate term trade over bot line is 49.89 within a risk range that's pretty tight. 48.25 is support.
Okay. EDV, decelerating volume, lower highs, looks like abandoned ship. In what scenario do we get to the high end of the range which has been revised downward as consistently as Fed GDP forecasts?
Yeah, the risk range on EDV is tightening. I mean, if I thought you should buy it here, I'd signal that. This one we have risk managed well. I mean, so for my critics that say that we just sat there and rode bonds, I mean, that's inaccurate. Obviously, if you pay for the product, you know that. But EDV is right in the middle of its range right now, and the risk range is pretty narrow. So the risk range right now is actually, call it, and I'm going to round it off, 108 to 114. And that's good, because the risk range for EDV at one point was like 132 to 106. And when a risk range is widening, I get out of the way, and or if I'm buying it, like EDV, I'm quick to get rid of it. Okay, let me say that again. I gotta get that chart out of the way. If the risk range is widening, I am less likely to hold on to it. And if I buy it for a trade, it'll be the first thing out the door. If the risk range is narrowing, you can be like Warren Buffett. You can own something forever. You know, narrowing risk range is a leading indicator for falling volatility and rising prices. So again, that EDV and TLT are seeing a narrowing risk range, just FYI. I'd just rather go back and signal EDV on a down day. I'm not going to buy it on an up day.
Okay. What has changed from a research perspective on Dryden?
On Darden?
Yeah, sorry.
Oh, yeah, we sent out a cover signal on that yesterday. Howard Penny. I can't tell you what's in the note because he hasn't written it yet. Unfortunately, you'll just have to take my word for it. When the analyst tells me that he thinks that some good things are going to happen at Darden, and he's going to start to elaborate on that from a research perspective, then I get out of the way. Okay,
Apple ranges.
Apple immediate term trade support 125, intermediate term trend resistance. What did I just say? Immediate term trade support is at 125. Immediate term trade resistance is at 128. If it can get above 128, this thing could get into the low 130s pretty quickly. The problem is that Apple's been correcting on decelerating volume, so that's not a problem if you're a bull. The problem is it makes it tricky because it's just a stock that's starting to signal lower highs, but it hasn't broken a big trend level of support.
All right, and then the next one is, can you talk about VIX risk ranges with commentary?
Yeah, I did at the top. I'll say it again. VIX risk range is 1303 to 1590 something. If it breaks 1303, it widens out to 1240 to 1590 something. So the volatility's risk range is actually starting to widen. That's a leading indicator that the risk range in the S&P 500 is going to start to widen, which would be a bearish signal as opposed to bonds, which are seeing a narrowing range, which is a bullish signal for the price.
Okay. Do you cover NTES levels?
We don't cover it. We don't have a coverage list. I think those are
Well, it says, no, I think it's on a, well, yeah, actually, that could be what he's asking. If we're covering, I thought he meant if it's a short, is he covering?
No, NetEase.
Yeah.
NetEase, we don't. We don't. It looks good. Obviously, a stock that doesn't go down looks good. It looks like a chart chasing stock.
Okay, levels on
Nothing wrong with chart chasing as long as the chart doesn't go down.
Yeah.
Look at Netflix. I mean, I use Netflix all the time. Nice chart. If they're going to say it's worth 180 times earnings, it might as well be worth 180,000 times earnings. It doesn't matter. People are just chasing the chart.
Okay, McDermott International MDR levels.
When you trivialize it like that, the real academic types get really upset. I'm not a real academic type. Although I do read more books than most academics. MDR. Another one. Looks good. So let's study this one for a second. If you guys could pop up MDR, I don't know if you guys can show that, but you won't be able to show it the way I want to show it anyway, which is by showing volume. So what happened on the 26th of May was that McDermott broke out on accelerating volume after breaking down on decelerating volume. That is a clean-cut, cover your short, buy signal, if indeed there's a fundamental there. And then ever since, what it's been doing is backing and filling, making higher lows on decelerating volume. So that's a bullish-looking thing. If everything I own looked like that, my life would be far better from a real-time alert perspective.
Yeah.
So we're going to hire more analysts because obviously the more analysts I have, it creates a higher batting average. So hopefully when we have 20 analysts instead of 10 sector, I mean, probably at that point I'll have 40 analysts. But the more analysts, the higher probability is that you have more ideas that look like McDermott.
Okay. This is interesting. Considering how much bearish talk there has been from most investors and pundits about bonds and rates rising, do you find it surprising that the positioning of net non-commercial futures and options now appears substantially less short on the 10-year than earlier this year?
Yeah, that is surprising. That's a great point. Welcome to the game of macro. Everything is a surprise. When you start in macro and you start with what you think should happen or what's rational, you should immediately check that at the door and maybe have a beer, because that's just not the way it's going to go. You're going to constantly be surprised relative to what should be happening or what you think is rational. This is the game, and we live in it.
Okay, and then just to I may have just to ask this question again on Feroli's Fed funds forecast.
We're not gonna. You're not. I'm not taking another question about Feroli. Okay. Seriously, is it about Feroli?
No, it's just I think I mean, the question may have misconstrued. The question is, what is the risk range in TLT if rates don't do what you feel they will? We still need to know the risk range of the other side of your trades.
No, the whole point of the risk range has nothing to do with what I think the thing's going to do. The risk range is what is. Yeah. It's like the weather. Like I would love to have sun every day, but when it's raining, the risk range implies the rain. It's not. This has nothing to do with the old way that you think. And I'm serious about this. If I'm going to get in here, I'm going to have to sometimes just come at these questions and call it like it is. The old way that you look at things, particularly if it's old wall research, is people come up with an idea on what things should be. And irrespective of what they are, they have a view to support what they think it should be. Mm-hmm. I have views on what I think should be. Those are called research views. But I also have what is, and that is the quantitative risk range. So do not mix up what I think should be and what the range is. What I give you the range in the TLT is quite consistent, and it changes every day. It's narrowing right now, it was widening before. That's what it is. And when I was telling you the TLT risk range was widening, you should have taken that as at least some kind of a cautionary signal, in as much as every sell signal I gave you on EDV. I think I gave you 6 in a row. So again, I'm going to stop there.
Okay. Next one, Kate. You knew we were going to ask about it.
I always get these kinds of questions like in meetings too. Don't forget. So on these process questions, sometimes I have people tell me what my trend means, and I'm the one who gave them the trend. So it's interesting how with time my process becomes incorporated into other people's processes, but it doesn't change what my process actually is. With all due respect. Kate, immediate term, I knew we were going to get Kate. 24.65 is support, immediate term trade resistance at 25.92. And the stock, while trying to bottom, still looks bad. That's why I haven't signaled buy on it, which is, again, it's a good example of Brian McGough likes it on the research side. I don't like it from a quantitative perspective. So what Brian said I should do, I didn't do. And the risk range is the risk range. It doesn't change. That it doesn't matter what Brian or I think. The risk range is what it is.
Okay. I rode this type of security wave for a while now. I sold my FireEye up from 29 yesterday. Do you have ranges on this?
Yeah, FireEye, just great call, by the way, if you're along that. Immediate term trade overbought signal is actually just north of 55, so I don't think that you'd give up on it totally here. Immediate term trade, but the risk range here is starting to widen, which is not a good thing. So you have no support down to 50.12. So again, 50. That's a $5 range, and it's at 53.5. Have at it.
Okay.
If I was long, if I had going back to the beginning of this, when I talked about taking a position up, if you were a bull in FireEye, you could have bought all the FireEye in the world in the low 40s, and you could have taken your position from 1% to 3% to 4% to 5 to 6, and at 6%, if it got to $54, you could sell half. That's how I was fairly aggressive when I trade my books, but I think that's a methodology that is worth considering because what you can do there is you can reduce your risk after having captured all the gains. You can also obviously create option strategies around that, which we're not going to get into. We're going to be here all day.
Okay. So we have our call on interest rates, but if that goes against us and Fed funds is hiked, I guess, and we do end up to 2% on Fed funds, what's like the downside deviation there?
Of if we're wrong, what's the downside in bond yields?
And I think that's the point you're trying to make, that it's kind of a Bayesian process, and you don't have to anchor on some forward-looking forecasts because you get new information all the time.
Yeah, I mean,
I don't know how you would answer that.
Yeah, and look, I mean, to be clear, I think rates are going lower. I have thought they're going lower, and thank God I didn't capitulate, at 2.55% on the 10-year because a bunch of people said they're going higher. I mean, I've been doing this one for 18 months. I mean, I've been saying this for 18 months. It's not, what will change our view is the fundamental research called growth accelerating. If we see that, we might change our view. Otherwise, I can understand how people get agitated and how people will consider all these different scenarios. But to be clear, if the Federal Reserve raises interest rates, there's going to be a lot more risk and a lot of other things than just bonds in our scenario. We think that a Federal Reserve rate hike would be the tipping point potentially for a U.S. recession. You drive the oil price back to the kind of 30, 40 level. You put the state of Texas on fire from a recession perspective. The Dakotas fully loaded. I could keep going. Corporate profits would be eroding at a faster rate because, of course, the dollar would be accelerating to the upside with interest rates. So again, there's a whole other risk management scenario on that this thing called the U.S. dollar was not agreeing with while people were, I think I'm the biggest bull right now on the bond market. And if I'm wrong on that, guess what? I'll be the only one that's wrong, because I'm the only one left, maybe. And I don't mean to say it that way. I know a lot of people have this view. But I mean, publicly, very few people have gone to the mat this last time. In fact, Gunlack even gave up on it. So again, if I'm wrong on it, everybody else is going to be right. And you know what? The probability of that tends to be pretty low.
Okay. Short Facebook, it's gone in my face. What are your thoughts on levels on this stock and longer term?
See, at least somebody here asking questions is being, that I appreciate that. When you say I've had something go in my face, I mean, look, it's always in my face. Look, Facebook, immediate term trade overbought at 83.25. A lot of downside, actually. No immediate term trade support, down to 80.44. On a stock like this, I'd probably stay with it on the short side for the next market pullback because you're going to be able to cover it lower because it's at the top end of the range. If it's in your face and it's still in your face, then you took the, if you took the adult decision to let it go in your face. But now, it would be a mistake to book it in your face. I mean, I think you'd rather book it closer to 82 or sub 82, just getting cute. But again, the immediate term downside, you get all the way to 80, no problem on Facebook.
Okay, we'll go with a few more here. Hologix.
Hologix looks fantastic. Immediate term trade upside to 38.45, which is, it's at the top end of its range. There's a pretty consistent narrative here on this call, which is a lot of stocks are at the top end of the range, particularly if the story has been good, like Hologix has been. This thing literally won't go down. Immediate term trade support is now 37.07.
Okay, BlackBerry.
Remember everyone chased that chart? Remember that? BlackBerry at 10, everybody's like, look at it, it's breaking out. 9, no support to 8.9, 8.90.
Okay.
It's bearish trend, by the way, BlackBerry. This is a great example of a stock that if you go wire to wire from April the 1st till what'll be July the 1st, the stock did nothing. But it had a lot of people say this chart is breaking out, didn't it?
Okay, and then moving on to some retail names here. XRT, and then the ETF, and then RL, Tiffany's, and let's see, I think there's one other in here. Let's see.
XRT,
Nordstrom too.
XRT, there was a good example of us. I still don't like retail at all. The demographic story, the U.S. story, I don't like it at all. But guess what I'm seeing now? A dollar signal that just put in an immediate term trade bottom. If that happens, what happens? Oil goes down. Look at your screen. And then what happens? If oil goes down, the consumer stocks go up. So I can not like it fundamentally, but the quantitative signal got us out of the way on retail, and I think that was a good call. Look, I don't make all good calls, but I know why we make these calls. And what I'll wait for next is more like a beta signal on XRT. I want to see the market kind of test the top end of my range, which we're close to, and I want to see, I'd like to get XRT off on the short side north of 101. because it's got a ton of downside. I mean, it can go to 97, no problem, because it just did multiple times. So that's how I think about that one. What was the other one?
There's, well, Nordstrom's in here. JWN.
JWN. Same thing. Looks like the same, you know, looks like Nordstrom was having some significant problems, by the way, when it was sub 73. Then the market move changes, right? And now we've discounted a dollar decline. The dollar can bounce, oil comes down, and retail stocks go up. I mean, that's the trade. That's how you have to think about these things. I get an overbought signal north of 76 on Nordstrom. I don't have that yet, and it does look like a good short if indeed you get that, because it has nothing's changed on the downside. The low band of the range is still at the year-to-date closing lows, which you saw obviously at the end of May.
All right. I think we'll wrap up there. Lots of questions.
Yeah,
that was good.
Great questions. Thank you.
Stuff.
Appreciate it.
Thanks everyone for tuning in. We'll catch you back here on future shows. Good luck out there.